What is up, Prop Shop YouTube? Austin Trades NQ back with another video today, breaking down price action trading part 2. I think it's really fitting that we filmed this video in March because recently markets, really indexes, NQ, ES, options, equities, almost everything really that's kind of the heavily weighted names in the S&P and the NASDAQ, really ranging for the most part. And as an indexes trader, as a futures trader, I recognize that this is a great time to get into a concept I've been wanting to talk about for a while. And in this video specifically, we've already covered price action trading part 1, reversals, retests, everything that goes along with context and conditions. And today, we're going to really get into the granular details surrounding expected value and the core idea in my trading process, which allows me to be consistently confident, consistently successful, and that is trading with context, with positive expected value, so that your technical setups can play out and you can execute with confidence and consistency. So without any further ado, let's get into this video today. Price action trading part 2. Let's get to it. Starting in February, March, we've seen NASDAQ. This is a 65-minute time frame, so you're going to get equal numbers of candles inside of that regular trading hour session. So this is going to show us every regular trading hour session day by day with a 65-minute candle, and this is going to be dating back till February. Now, it's really obvious for me just doing some basic technical analysis, and again, this isn't necessarily a technical analysis video. We've covered price action trading in multiple different lessons already. We've covered lots of technical stuff, but I want to get into the details of expected value and how, if you've struggled in March, if you've maybe had slower results, slower process, maybe even letting some of that impact your psychology and maybe have some sessions of tilt, sessions that are emotional, blowing up some accounts. These are going to be things that I think we can reflect on and use as a benefit and as a tool to put ourselves in a winning position in the future. So for me, looking at this 65-minute time frame, looking at the daily, we've really been in this same range since, I hate to say it, really since closer to November, but this range tightened up a lot in February, right? We saw this rejection of all-time highs. We sold into this candle body that was February 5th, February 6th, and then we really stayed inside of this range for the entire month and most of March so far, testing prior all-time highs, catching bids, but failing to see a directional trend higher or lower. And this is kind of the top-down approach from a price action trading standpoint that's going to begin allowing me to build expected value. And if you don't know what expected value is, this is effectively, in simple terms, the probability of my trade ideas working out times the risk and relative reward. So when these higher time frame conditions for me as a momentum trader are clearly and obviously trending, like we saw here in September of 2025, a break of all-time highs, clear upside momentum, retest of prior candle bodies and structure, more upside momentum, and then eventually some volatility kicking in. This is going to be effectively the 10th to the 10th of October, a month of really positive expected value trading. And again, that's going to be the probabilities of my trade ideas working out, which here would be long into all-time highs with high quality risk to reward on the lower time frames. And when we see these higher time frames really trending, and for me, it's super simple. I've talked about this in past videos. I'm going from the daily to the 65-minute down to the 15-minute time frame during regular trading hours to identify my levels, my zones, and my structure for context and expected value. But again, to get into the main verticals of this lesson, that's the first thing I'm trying to do. Before you even analyze your fair value gap or your 5-minute flag pattern or your supply and demand retest or your EMA crossovers, setting up expected value and understanding not bias but context. Am I trading with a higher time frame trend? Is there a 50% probability this trade idea is going to work out, or is there a 90% probability that trade idea is going to work out? And is that giving me positive risk to reward or negative risk to reward? These are those micro decisions that as traders in price action trading part 2, when we begin to understand expected value, we begin to build this top-down approach to our lower time frame entries, you're going to start understanding why you get so frustrated when your 5-minute flag pattern doesn't work out or your 5-minute fair value gap doesn't work out, because in different conditions and in different contexts with different expected value, your trade ideas are going to have a much stronger or maybe much weaker probability of working out. And really the goal is to understand where, why, and how that is happening. So again, daily chart clearly range bound. We see candle bodies, candle wicks here, 25,500, prior all-time highs being tested and held at demand lows, 24,000, 23,800. So as long as the daily chart stays between 24 and 25,500, 1,500 points of range, I want to make sure I'm trading with that directional trend or with support and resistance. So the question now becomes, do we have a clear directional trend? And I would argue no. I would like to be trading at support long or at resistance short, and not trading so many trending momentum plays as long as the daily and the hourly chart are going to stay in range. And now we can begin building clear levels to trade off of on the 65-minute, 15-minute time frame, which if you've looked at the Trading Zones Masterclass, Generating Repeatable Edge with Trading Zones, Price Action Trading Part 1, we have a ton of videos on the channel explaining how to do that. I'm not going to do that in this specific video, but as you can tell, 23,800, 24,000, these are going to be levels, 24,000 right here, that on NQ, the market was attempting to hold. So I'm gonna go ahead and change this to NQ real quick. You'll see exactly what I'm talking about here. This was daily supply highs, and this was daily demand lows. Notice how price sold from these highs and bounced from these lows. Now, we still wanna be able to execute on lower time frames. So on these 65, 15-minute time frames, can we identify an area where there's lower time frame demand and lower time frame resistance or supply, where we can identify possible trade locations, high probability trade locations. And for me, I see that very clearly, and then we're gonna go filter down to the 15-minute time frame and identify where we could have traded and kind of talk about expected value. So we already know we have this upper supply zone in the 25,500s or so, which is gonna be this level here. And I'm gonna go ahead and draw a zone at my next clearest support level prior to March 20th or so, which would have been these local lows that kept holding candle body, candle wick, candle body, candle wick, candle body, candle wick, and so on and so forth through the rest of the session. And this is going to now act for me as potential areas of support and resistance, supply and demand that I can trade confidently, consistently, with directional bias, and I can treat this as a high probability trade location with positive expected value. So we're going to slow this down just a little bit. We're going to add another level and zone here so you guys can really see exactly where these levels, zones, and structure are at. 25,385, 25,465 or so, and then prior lows, the candle bodies. This is what I would have been looking at for this prior month to really act as support and resistance. And for me personally, the only thing I would have done is identify the 50% retracement between this body low, this body high, demand and supply, and then trade around that while using that as a kind of midpoint of 50% for price to trade into, based on my thesis that we're going to be range bound and that I expect expected value to stay pretty balanced. 50% range, top of range, bottom of range. We get the picture here. So we're going to go ahead and mark 24,880 or so, clear level, remove this fib retracement, this 50%, and then we understand bottom of range, top of range, middle of range. Now, for me personally, in this entire month, the past month of February, this entire month of March, I've been on social media, I've been trading live, I've been doing one-on-ones, I've been talking to people on YouTube and Discord and this, that, and the third, and I recognize both for my own objective results, it's been a slower couple months. It's been challenging for most people. But then for me, trading is a behavioral game. I want to understand exactly why this is happening and how we can possibly analyze the price action, make well-informed decisions, and trade our playbook confidently. So where is the positive expected value? And again, lastly, in this past month and a half, 2 months, if you've been trading strictly EMA crossovers or strictly looking for really big momentum moves, I think you've probably been experiencing internal conflict, emotions, frustration when these breakouts fail at these upper levels, when these breakdowns fail at these lower levels, when we see these big bounces off the open, right? These price action concepts that have been happening recently have nothing, and I will repeat, nothing to do with your playbook relative to your double bottom, your triple top, your EMA crossover, and your fair value gaps. The market is an art and not a science. And your ability to build this picture throughout the session, throughout the month, throughout the week, that gives you a clear understanding of where are the high probability trade locations relative to the current context / expected value. And that's the main lesson. If you're still sticking with us in this video, you're paying attention, you're listening. It's not so much about our ability to draw these zones. We've covered that in past videos. We talked about it in this one, and we understand technically what was going on here. Now, of course, in hindsight, But I've been trading live in front of a pretty decent sized crowd of people at this point and have been able to pretty much navigate this price action defensively and successfully. But it hasn't been because my 5-minute second buyers or my 5-minute second sellers or my higher time frame break and retest plays of levels and zones are firing and providing me a ton of opportunity and a ton of reward. Actually, it's the opposite. It's been mostly defensive trading. We've been largely picking my spots pretty carefully, taking less trades throughout every session. I've been sized down the past 6 weeks, but it's been a reflection of the real-time commitment to adaptability and agency. Saying something like trading isn't simple. It doesn't have to be extremely complex, but the ability to recognize these changes in real time, even if we go all the way back to February 5th into February 20th. Once we created this high and we failed to close below and trade below 24,500, 24,600, we had to begin assuming that there was a range that could be built into these levels. And you can see how if you fail to have your process in order and you fail to really have the tools and the systems and the top-down approach to technical analysis that's going to allow you to be successful, then you missed out on a lot of opportunities to be a buyer in demand. And it's fine if you want to trade only continuation trades. I'm not making an argument for one or the other, and I'm definitely not telling anyone how to trade. I'm saying something simple like this. Once you commit to a higher time frame technical thesis that is surrounded not around your technical entry itself. Hey, I should be taking a double bottom or a triple top or a fair value gap or an EMA or a break and retest. No, those setups are going to show up. And the truth is, you can change the time frame and your EMAs and your levels and zones to make those setups always show up, and that's the danger. But if you want to make trading easier, if you want to make trading more joyful, if you want to trade with probabilities and expected value on your side, I highly recommend building this top-down framework as a price action trader that allows you to recognize first and foremost, should I be aggressively pursuing my edge this week? Should I be aggressively pursuing my entries in my trade management this week? Or should I be sized down and playing more defensive, letting the markets come to me and waiting for my alerts to go off at these high probability trade locations? And there is a difference, and I don't care what any trader says. We can argue about it in the comments. We can get on a call. We can talk live in front of hundreds or thousands of people. It doesn't matter to me. My trading has been most successful when I wait for this higher time frame expected value, the context and conditions of the market to become almost simple stupid, and they eventually do. It's not often, but these are what we'd call tails in statistics. Identifying where I can trade and when that's going to be fruitful in the long run. Something like if you took 100 break and retest or EMA crossover trades the past month, I think only about 40 to 50 of them would work out on average with a little bit less reward than I'm currently looking for or normally looking for. If, in a much different example, we're going to get to one real quick, we recognize when markets break structure, right? 15-minute time frame here, 30-minute time frame here, excuse me. We had a prior low, and we're going to cover this super quickly, talk about expected value. We had a prior low right here at 24,450 that we broke. And once price gets back above prior lows and we start to see covering in the markets, we create new structure. This is where for an extended period of time, we have a failed breakdown. We accept the auction back above local lows. We see a resistance break and retest. So this is where I would begin thinking to myself that because we have gaps to fill to the upside, and we also have some clear supply zones that if cleared, could see a formal trend back to new highs, and markets love to test new all-time highs right after they sweep liquidity. We get those draws. And so for me, this would be the type of trade where not here, not even here, but after this retest, this is where expected value, November 25, 2025, would have been very strong and in favor of my process, my edge, for an extended period of time. We saw upside momentum, flags, break and retest, continuation to the upside for almost a month straight, right? Excuse me, that's incorrect. Almost 2 weeks straight. We're on a different time frame now. But 2 weeks of consistently successful trading, 2 weeks of trading with aggression, but controlled aggression. Something that I learned early on in my career. Sports helped with that a lot, playing collegiate sports. Controlled aggression, adaptability, and understanding sometimes when it's time to use your skills, to be confident, to put your foot on the gas, and to kill your opponent, to kill the markets, to go and get what's yours. Someone needs to tell you, you have the tools, you have the confidence, you can do that. but you're not going to be able to do that in every single market condition. You're not going to be able to do that every day, 24/7. And really, more than anything, the ability to wait and recognize some key concepts from this video, some key lessons from this video that are going to allow your lower time frame playbook to generate more repeatable, more consistent edge is something as follows. When we look at the higher time frames, if we can identify expected value first on the daily, and then for me, I'm using a blend of the 65, 30, 15-minute charts on regular trading hours to recognize my levels and zones. Talked about this in past videos. Regular trading hours is when I'm trading. Regular trading hours is when the majority of volume is in the market. And 90% of my trade volume does come in the New York Open between 9:30 to noon. And that's where I want to be focused on being a high performer. So for me, you can use different time frames, different processes, but the key concept remains identify higher time frame context and expected value first. Once we do that, trading can become, and oftentimes does become, a lot easier. For example, if I am to recognize, let's say, demand lows, notice how we held this, we held this, we held this, and we held this. How many times could you have been long off of support for the past month? 1, 2, potentially 3 into a gap up, a little bit tricky Friday to Monday, and maybe even 4. Again, these are ideas that are higher probability for the current context, for the current conditions, and these locations are going to be where there's positive expected value. Why? Because we've already identified the market is not in a big trending cycle on higher time frames. I want to be long at support, I want to be short at supply, and I want to be trading at the edges of range until ranges break and the higher time frames start trending. And let's use this logic to then analyze a winning trader versus a losing trader in a trending market. Let's say the markets break highs here, Thursday, September 11th, and we see this extended follow-through move all the way into October of 2025. And so for the average retail trader, if they fail to build context, if they fail to understand that at this time, markets had a very simple process. And this is what I'm talking about. These sessions where we see continuation, not so much here, August to September, but May, June, July, all the way once we broke this range, September, like I talked about, this is what we want to be trading. These are the expected value conditions where you're going to make a high quality trading career, you're going to be confident, and you're going to allow those setups to play out over time in your favor. So again, September, I just want to cover this really quickly. We had a clear and obvious trend for a very long time. Finally saw some selling, some volatility. So it's kind of obvious, right? We had this range we needed to break, range high, local high, range lows, local lows. So once price cleared this, we saw a hold of demand and we finally got out of this range. We broke above it as articulated. Price really saw a beautiful move on this 65-minute time frame Friday, Monday, and this lasted higher highs, higher lows, holding prior demand, some volatility of course, but continuation here all the way until this big sell for effectively Friday, October 10th from Friday, September 12th. Almost a month of really consistent, very strong positive EV, nice range and volatility trading. And again, this isn't going to change based on your 5-minute setups, your 1-minute setups, your 2-minute setups. But those exact lower time frame setups are going to work more consistently. They're going to provide more reward. And if you're taking great entries, oftentimes, ironically, you're going to have less risk taking really tight entries with higher time frame trend or with, more than anything, higher time frame positive expected value. I'm going to make a video specifically detailing expected value and how it plays out in my live trading process with a 2.5-hour live trading video coming up very, very soon. I'll be trading with the prop shop. We'll be live. We'll be talking it out in chat. I'll be recording my screens, talking to you guys on YouTube, posting the full live session with P&L, execution fills, etc., all on the video. And this is really the bread and butter of my trading process, letting expected value dictate my decisions, letting expected value dictate how involved I'm going to be with the market first and foremost, and then attacking my lower time frame setups. If you can do that, if you can build the patience, the experience, the consistency to allow the higher time frame tides, the higher time frame winds of the market to trade in your favor, then your lower time frame setups are going to be much easier to trade, much easier to manage. And ironically, you'll begin solving some of those psychological errors, that you're currently dealing with on a day-over-day or week-over-week basis. As always, if you've liked this video, please like, comment, subscribe. Tons of new content coming out soon. I am currently live trading in the Prop Shop Discord during the beta, and we have a really big announcement coming out this weekend on YouTube. If you're a consistent listener, that I'm sure you guys will appreciate and be excited for. Without any further ado, we're going to take off. We're going to keep live trading, keep killing the rest of this market in March, and hopefully we see some new inflows in April and we can take advantage of that as well. As always, thank you for tuning into the Prop Shop. Have a great day. Trade safe, trade well. Peace.